So good evening, and welcome. My name, for those of you who haven't attended an IPA event before, is David True. Um, uh, I have been one of the officers of an IPA for 12, 15 years now, and I'm very, very glad you've joined this event. I'll do a couple of sort of housekeeping things, and then, but first I want to say there was a movie about Travis, and I never say his name right, Travis Kalanick, the guy who founded Uber, a couple of years ago that you may have seen. I'm going to steal something from that to say that I'm super pumped about having this panel because it's a great, relevant topic, and we've got fabulous people on. So you've tuned in at a good time to hear something really interesting. Mechanics of this, there will be a discussion that goes for a bit under an hour. If the questions are really popping, it'll go a little longer than that. After that, there will be 1 to 2, depending on time, virtual discussion sessions. So you can kind of speak to people and ask questions that you didn't get to fit in during the actual panel. And if you have questions, obviously put them in the chat. And I don't know if I missed anything. Oh, the other thing, please, to keep the attention on those who are speaking and discussing, turn off your, obviously mute your mic and turn off your camera once the session starts. So this is being done in collaboration with our friends at PayCLT out of Charlotte, and they did the yeoman share of the effort in putting this thing together. So I got to give kudos to them. And it is Nick Williams who led that effort and brought this incredible panel together. So I will pass it over to Nick and let him get the show started.
Thanks, David. For those who haven't met, my name is Nick Williams, and I'm a part of the PayCLT leadership group and outreach group as well. Super excited about the partnership that we have every year with NIPay. We do 2 of these events, and they're always some of the more dynamic ones that we get to have. So I don't think we could have timed it better to have this panel on fintech and regulation. And in order not to steal any thunder from my guests, I'm just going to say um, the topic and the panelists that we brought are top notch, and the level of expertise that we have on the phone is phenomenal. So I'm going to get out of the way and introduce Alex Johnson, the author of Fintech Takes, and he can run with the panel and introductions from here. Thank you so much for your time.
Awesome. Well, thank you very much, Nick. I appreciate it. I think this is the second or third time I've gotten a chance to moderate one of these sessions. Always in October, always right before Money 2020. I really appreciate the opportunity to do it. As you said, this is the perfect topic. The irony for those who don't know how PayCLT and NIPay work is they plan these things months and months in advance. I've never participated in an event series with so much planning and diligence done in advance. So we picked this topic a while ago, and the industry moved in our direction, and the market moved in our direction because regulation in fintech, I think, has become probably the number one topic that I get asked about, and is the number one topic that I think is on the minds of both fintech founders and operators, as well as bank executives that are trying to figure out how to work with fintech. So, what we are going to do today is actually do a little role playing, which is kind of a strange thing to do for an event like this, but we thought it would be the best way to explore some of the different conversations and points of tension that exist in the regulatory space right now around fintech, and really to highlight the expertise of our panelists. I will be playing the dumb person on this panel. And so I want to, before we dive into our role playing, introduce the smart people who will be offering their expertise and experience in the form of their commentary. So I'm going to have each one of them introduce themselves. And Matt West, why don't we start with you?
Yeah, thanks, Alex. And I think I've been on at least one of those other NIPay and PayCLT events with you. So thanks to both NIPay and PayCLT for having me again. Matt West, I run a company called Xenios, and we provide technology and advisory services to partner banks or fintech banks. And previously, I was a chief strategy officer at a publicly traded bank that started and grew their fintech partnership business to about 3 billion in deposits and 10 to 20 million per year in fee income.
Awesome. Thank you, sir. Brad, why don't you go next?
Great. Thanks so much, Alex. Brad Rustin, I chair the financial regulatory practice at Nelson Owens. We work with about 3 dozen of the big fintech sponsor banks developing partnerships. But today I get to take off the lawyer hat. I'm not playing lawyer. And today I am Martin Michael Powell, a hypothetical regulator of a generic regulatory agency who's going to be talking with all these yahoos and providing them with my depth of knowledge and insight into fintech structures.
Excellent. Thank you for introducing both yourself and your alter ego. That is awesome. And I believe we have Matt Janiga as well. Matt, number 2, would you care to introduce yourself?
Absolutely. Thanks for having me, everybody. My name's Matt, and for the last 10 years, I have lived in California where my own. So for the last 10 years, I've lived in California working at tech startups where things go wrong quite often. And when that happens, the companies I've worked at tend to be at scale. So just by way of background, moved out here, was outside counsel for Square back before they changed their name, and moved out to come to California to come work on site pre-IPO. Help them stand up Cash App and their lending product. Also worked for Stripe, where I wanted to do a bunch of similar things in payments and lending for them, both in the US and then also working on some of their multinational payments products. But I've really done a tour of duty across issuing and lending since then. And I am currently at Trustly, where if I screen shared, you would see lots of documents about the Section 1033 rule that came out earlier today. But we won't go too far into that. Today, I'm playing the role of bank compliance officer, and I believe maybe the general counsel. So the first thing I'm going to do is I'm going to ask someone on my team to do an information security check, just so we can figure out who screen shared that earlier. But we'll go on from there. Alex, I'm going to toss it back over to you so you can get us going, because I know we've got some great content, and Brad especially has some smart insights.
We do have all of that. And again, apologies for our brief foray into, I guess, a different type of role playing. That's not what we're doing here, though. So as I mentioned, we are going to run through a couple of scenarios just to sort of illustrate, I think, the life cycle of how these bank fintech partnerships evolve, and putting sort of a current regulatory lens on those discussions. So for our first situation, I'm going to be the CEO of Celtics Bank of Boston, because today is a very auspicious day for me. So we'll be the Celtics Bank of Boston. Matt's shaking his head already. We are a mid-sized community bank, mostly operating in commercial lending today. However, my mother, who has been the CEO of the bank for the last 39 years, just retired because, again, we won Banner 18, so it's all good now. And I get to step in as CEO of the bank. And this first conversation will be with Matt West, who will be playing the role of my Chief Product Officer. Matt, are you ready to go?
I am. And this is a conversation I feel like I've had before.
I had a hunch it might be a couple of times. All right, so here we go. Matt, good news. I just got back from a really great fintech conference where I discovered that banking, fintech partnerships and banking as a service are not dead as I had thought they were. They are very much alive, and I think we need to get into this space as soon as possible.
All right, let's dive a little bit more into our current situation, then we'll talk some about the risk framework.
Okay.
So in the current situation, why don't you tell me a little bit more of why you think you're interested? Are we looking to grow deposits, do some lending, or are you just scared to miss out?
Well, I am scared to miss out. I've been telling my mom for years that we needed to do this, and she wouldn't listen. So I do think that we run the risk of missing out if we don't jump into it. I think that it can be a really great way to gather deposits. And I've heard that from a number of other friends of mine who are CEOs of banks who have tried this. And I think given the situation with our balance sheet and the cost of getting deposits, this would be a good way to go.
Okay. I think that's pretty reasonable. We see quite a few opportunities to gather lower cost deposits. I wasn't sure, you thought you may also look at it for the lending opportunities or the fee income, but it's good to have a little bit of focus.
I'm interested in fee income as well, for sure. And who knows, maybe lending someday, but I was thinking deposits first.
All right. So what do you think this is going to cost, and how much are you hoping to get in terms of deposits and fee income? Are we trying to get 10 billion or 10 million? What's your goal here?
I would say somewhere in between. I was thinking more in the realm of like 500 million maybe to a billion. I think there's a lot of room to grow. In terms of my expectations for how much it's going to cost. I mean, I don't know, like tell me how much it costs to spin up another branch, right? It's the same as adding a branch. We should be able to just sort of fold this into our existing operations, right?
Yeah, I think we'll keep going to talk a little bit more about the number of programs we want to support and the types of programs. I think
Okay.
that's going to drive our costs a little bit. Probably also going to have to talk about our compliance officer and our operations team, and if you think they're up for it. So typically, from what I've seen, three critical roles that we need to make sure we have in place. We got to have a risk and compliance officer who's built to scale and to scale those operations and has done it before. We'll want an operations leader that's pretty tech savvy and a good problem solver. We're going to bump into a number of things we haven't seen before. And then, of course, someone to manage the relationships. That might be you, it might be me, but those are the three critical roles. And then from there, a lot of the costs are going to, at least on the people side, we'll need to scale with activity. But I think those are some critical ones to think about. Then probably last question, just to help me understand what you're thinking. Have you thought about types of programs? There are payments programs, there's banking as a service. A couple of years ago, everybody loved crypto, but now no one will even say the word. They call it digital assets. So what are you thinking we might want to get into?
Well, not crypto. I was thinking more banking as a service from a deposits perspective, and then was also curious to get your take on the opportunity around embedded payments as a method, both to drive payments fee income, but also potentially there might be some sort of associated deposits with that activity. So was interested in embedded payments specifically.
Okay. Yeah, on the banking as a service piece of it, we'll probably want to dive further into whether the end user of is going to be a consumer or a business. Pretty different risk profile. If we stick with businesses, then that's all easier. And as we go over to embedded payments, I think that's another important piece too. Or what payment rails will we be supporting? Are we talking about wires, ACH, RTP, FedNow, virtual cards? I think there's some real opportunities if sort of matching up the risk reward profile in business transactions that are one-time type transactions where we're not establishing an ongoing account. Those tend to be a lower risk and potentially higher reward. If we go consumer, we're opening account, banking as a service, that tends to be on the higher end of the spectrum for risk, potentially higher reward because there can be more deposits. But we bring in the consumer compliance risk as well as a scale risk, which probably leads me into the next topic, which is we'll talk a little about the risk framework and really want to think of it as there are product specific risks. So product meaning what are we offering to whoever's consuming it? So it may not necessarily be our partner, but the legal structure in most cases, we would think of this as it's a product that the bank is offering, and we're contractually delegating some work to be done by the partner. So I think the first is what is that product that's going to be offered to the user of the program, which could be a business or consumer. So that's the first framework. Or first part of the framework is what are the product risks. The next one we want to focus on a third party. If we're going to do this with a partner, they introduce a number of risks that sort of layer on top of those product risks, especially because we're going to be or we will be delegating tasks or assigning tasks to them to perform. So their ability to do that, their own controls, their ability to stay in business and not go out of business and leave us with all the work to do. And then the last one is scale. I had multiple regulators tell me directly, one in an early exam is when we think of what programs or opportunities that we need to escalate to the board for their approval, they've said very specifically, one of the factors has to be the number of customers or number of accounts that are included. And then another friend of mine, a CEO at a bank, who's in an exam, his examiner told him, he said, "Hey, you're kind of lucky. You don't have much activity yet. If you had a lot of activity, I'd have to have a lot written in my report. Because you don't have very much, then I'm able to have less in my report. So I think the amount of activity is a key factor here. So, but I'm excited to get started on this with you.
Well, I'm excited too. Thank you for not just blatantly shooting down my idea, but giving me a framework and a way to think about it. All right, we're going to end scene for a second. So first of
No,
all,
no, no, Alex, wait. Before we get off this, I think one of the things that I always think is a really interesting question is to have straight talk with the executive that's bringing you this concept. At least from the Silicon Valley side, what I found is usually there's a genesis of they were talking to an investor, so a board member,
right,
or they were talking to somebody they know, they grabbed lunch or coffee or drinks, and somebody said, "Hey, this great explosive thing is happening over here. This new business line is being built." And this is so fantastic. So the executive comes back and without giving you context about what they're trying to copy or replicate, right? They say, I want to do an X. And a lot of times, right? And thankfully, we have Matt who just walked us through all the considerations, right? So you have more of an understanding now, and our listeners have more of an understanding now about how they may want to approach the business aspects of this, right? And start to structure controls and compliance elements, et cetera. A lot of times folks don't understand the complexity of what they're doing or even what they're chasing. And I think, you mentioned BAS. So in my head, I was like, okay, have you been talking to somebody about Synapse? Like, are you trying to copy Synapse? Right? You're trying to copy something else. But sometimes what I find when you ask those questions is it comes out that the executive is trying to copy garbage. And, and if they pop up the name that they're trying to do, you can get a good sense of, oh, I'm aware of that in market, right? Or you can go do some research on it, go pull it up and be like, I see why you're excited about this. Here's a couple of things we should do differently. Right, you can start to pivot them over. And sorry, with that, very happy to end scene so we can get to the next
that was
part of
great.
this.
Actually, you jumped to where I wanted to go, which is I wanted to get a little feedback from you and from Brad on things we should have covered or other things you would do, because I think that you make a really, really good point about asking the why behind it, because you'll be shocked the number of banks that get into banking as a service because their neighbor's daughter's husband just started at a startup and they're looking for a partner. It's like weird stories like that you really wouldn't expect. And to your point, Matt, like that's not always necessarily the template that you want to copy or the specific area you want to get excited about, right? Like I just learned that cannabis banking is challenging and there's an opportunity there for us, and it might ignore other risks that are being taken. So I think that's a really fairly made point. Brad, anything you wanted to jump in on and things you've seen in those initial interactions?
Yeah, just one thing to add on to what Matt was saying, which is I found a lot of times executive teams don't understand the risk continuums with fintech. They go to conferences, they hear about fintech. And in our world, BaaS is an animal, embedded payments is an animal, card is an animal, all of those with different risk profiles. Crypto payments is an animal, cannabis payments is an animal. And a lot of times the banks are not drawing that distinction yet. And they're either going to a technology integrator who's kind of promising them these hypothetical fintechs that are going to feed this program.
Yeah.
Or to your point, they've got a refugee from another bank who's looking to move.
Yep.
And they're really not understanding kind of this paradigm. And I think, working with Matt on some of these, one of the things he does great is give me a defined product description for what it is you're offering. Don't tell me fintech partnerships. Tell me you want to do embedded payments for commercial entities that are doing rent payments. Okay, we can work off that risk case. The other thing is, let me put on my regulator hat for a second. One of the questions I always get is, do you talk to me at this point in time, or do you keep this a secret and wait? And I've seen all sorts of answers to that question. Do you spring this at your next exam, or do you socialize it with your regulators? I don't know how you, Mr. CEO, feel about that.
Well, so let me ask you that question in return, because as we dig a little deeper into our scenario, we can do it either way. So I'd be curious to get your take when we get there on which one would make for a more instructive role play. But no, I think that is a really, really good point. And it, again, like the specific product thing, the reason I framed the initial thing with Matt W. the way I did was I think a lot of times it does start as we need to get into fintech. And it's like, that doesn't even mean anything. Like, what does that mean? What are we going to offer? What are the risk profiles associated with the different product offerings? I think one question I might bounce back to you guys really quick before we jump into our next scenario is, how do you think about or talking through with executives the sort of trade-off between risk and reward, right? Because there are different risk profiles to these products, but generally speaking, where there's risk, there's also the potential for more profit or more growth. And like, how do you explain that trade-off and how to think about that the right way? Because especially now that regulators have kind of cracked down on the space, I'm guessing the default is like risk bad, we want to run away from risk, but there can be profit there too. How do you think about that trade-off?
Maybe I'll jump in with Matt,
Sure.
but I kind of view it as a moat, which is the moat is getting deeper and wider. But if you're on the island, there is a lot of profitability. And so if you're going to do this, don't go halfway. I mean, where these programs do is you put 4 full-time employees and you get some consultants and you try to launch, meaning it's got to align with the long-term vision of your bank. And if you're not planning to transform your bank with 3 billion in deposits to where you can start getting scale on these programs, this is never going to make you money to try to do onesies and twosies the whole way. I don't know, Matt.
Yeah, Matt's.
I'll jump in and I'm going to weigh in on Brad's question of when to engage a regulator. Just a quick thought there.
Yeah.
And the middle ground is before the next exam, but not until you really understand the program and can talk about it intelligently. So that there is such a thing as too early. So it's usually sometimes after due diligence is complete, probably already talking and discussing contracts, because they're going to be speaking from specific experience, they're going to ask right at the beginning is, do you have a contract? Can I see, even if it's draft, let me see the contract and let me see your due diligence. So I think that's from experience, that's where it tends to be. So risk reward, I agree with Brad, is understand the scale more tactically, and using some bank speak. A lot of times I'll look at ROA. So anytime I'm helping evaluate an opportunity, we'll put together the pro forma, the financial model, we'll estimate an ROA, and I'll say, all right, if you typically want to get 1 or 1.5% ROA, you should be at least double that. So because I'm sure we missed some costs and we probably overestimated the upside, but also there's some additional risk. So I think a rule of thumb and other bank execs I talk with is probably 3 to 5% ROA is something that they would look at for a specific opportunity. And that's just if we're looking individual or a particular product line, something we're trying to get to.
Yeah, I would toss in there, I think, especially if folks on the phone are thinking, there are areas that I should be entering. I would say take a look around at your neighboring banks, right? Because there tends to be like a herd-like cluster of banks that are really good at certain things. So Utah is really well known for lending partnerships. The regulators there are very experienced with seeing those partnerships, both in a consumer and a business context. So they've seen a lot of things and they can offer you guidance, right? But they also can get comfortable with something very quickly. And there's a lot of talent in the local ecosystem for you to tap into, as well as great folks, right? You can call Brad or Matt as well if you guys have questions about some of these things. So that's one way to go. If there aren't other banks in your area kind of doing anything like this, it may make sense to start narrow. And Matt, I really like the comment you made earlier about the difference between business and consumer, right? Because I think as you're taking a look at some of the things that regulators are focused on, obviously AML is a big one, right? Reconciliation is a big one, but it's those consumer touch points and those consumer risks. And we'll talk more about that in just a minute, because Alex, I know we have another segment coming up here.
Yes, we do. It's actually a perfect segue. So we'll jump into our next sort of fast forwarded version of the scenario, which is we're still Celtic Bank of Boston. We are committed to going into fintech in sort of the general areas that we described, but now we are bringing in compliance Matt to talk to product Matt and me about what we're planning to do here. So, and we'll let compliance Matt, both are, I will say you're our chief compliance officer and general counsel, and you can give us some additional guidance on what we're planning. Okay. All right. Compliance Matt, I wanted to bring you together with product Matt because I don't really do the details. I do strategy. I do big picture thinking, but we're going to get into fintech. This is something that we're going to do. We are committed to it. Some good advice we've gotten is that it's not worth doing onesies and twosies. So we're going to make a big splash in this space, specifically focused on gathering deposits and potentially generating some fee income. Product Matt can maybe fill in some of the details for you.
Yeah, I don't know, Matt, if you want to briefly rehash what we're building here, otherwise we can dive right into the compliance side. I'm good either way.
Yep, we're going to go with some consumer-facing banking as a service programs, and then some business embedded payments. Probably going to do some maybe accounts payable automation, some one-time use virtual cards and wires and ACH to pay. But let's stay on the business side for embedded payments.
I love this is great. I was talking to all my banker friends, and David asked a great question. David, we'll circle back to this when we do our discussion after this section here in just a minute. So, all right, Alex, you know, because we make you take that annual compliance training every year, we
Yes.
have to do something called Bank Secrecy Act and money laundering sanctions right here at the bank. And you
Yes.
know, because we offer some limited general purpose products, right, to our retail depositors and customers, that there's an alphabet soup of consumer regulations that we do. And you also know, because we have them come to your desk every month, you know, when you're not busy eating cheeseburgers and other things or watching Celtics games,
Yeah.
that we escalate complaints, right, to the executive team.
Yes.
So I want you to think about all those functions we have today, right? You know, we're a little bit strained, right? We're just at the breaking point in terms of staffing and tooling and things like that. We need to take all of those processes and we need to level them up and pull up a level where we can make sure that either we are doing those things, right, for this new banking as a service product. Embedded payments is a little bit easier. We'll talk about that in a minute. Or we need to understand how the partner is bringing capabilities, tooling, and staff to the table that we can see. So I want to talk to you about a couple of things. People talk about pillars in the AML space. I'm going to pull us up a level and talk more broadly about compliance pillars. So obviously the first one we talked about is AML and sanctions. So one of the things we really need to make sure of, whether it's in that banking as a service component with the consumers, or it's that embedded finance component, is that we're collecting the right onboarding information to know our customer. Because when you look at those regulations from FinCEN and the other banking agencies, you're going to see that they're going to pierce through either that banking as a service platform or that embedded finance offering and those channel partners we're having, right, to distribute us on their websites and things like that. And they're going to recognize those people predominantly as bank customers. So we want to make sure that we're collecting name, address, date of birth, social security number, and then verifying that. In the business context, because we're likely going to serve small businesses, we have to make sure we're collecting beneficial ownership information. So we need to at least ask them, does anyone own 25% or more of their business? And if the answer is no, they have 100 relatives and they all own, 1%. We at least need the name, address, date of birth, and social security number from the control person. Now, on top of that, we have to do transaction monitoring right across everything. And then if we're ingesting information in, right, especially that name and address information, we want to make sure that we're sanction screening that. And we've got to be running that on a regular cadence, not just when the customer onboards, but also when the list is updated. And lately, as you probably have seen from the emails I've been sending you, I think you've been seeing them, right? There's been a lot of updates to the sanctions list based off of some of the Russia and Ukraine challenges that are going on. So we want to make sure of that. Now, there's a couple other things to call out. If we're going to go into partner banking, right? I've been talking to my friends and been reading the consent orders. So another big thing that the regulators seem to be focused on is, what is our compliance management system? And really, how are we handling customer support and complaints, especially in that consumer lens? They're going to ask us about that small business lens, but from what I've been talking to some of the other compliance officers at other banks, they don't get too many direct complaints in that business context or those embedded finance business capability channels. It's really going to come in that consumer context where someone can't get a hold of the fintech, so they're going to read the T's and C's or the website footers that we have that fintech put on, and they're going to boomerang around and call our customer support folks who may or may not know what to do. So we've got to train our folks, make sure we can take that in. Also, we want to make sure we're doing proper oversight, both of the banking as a service partner, but we want to make sure they're not obscuring the programs that are coming on board of them. So we need to look at the partner and also reach through them to their partners. And we need to make sure we have a way to contact everyone. So I would recommend not only that we have contacts at the banking as a service provider, but also that we get contact information and potentially do some diligence and meetings with the entrepreneurs that are building on top of that banking as a service platform, so we can assess their potential risk. And I'll give you some examples where people have shown up to other banks and they look like they know what they're doing. They're seasoned, grown-up business professionals, late career, but then they YOLO something. YOLO is something my kids tell me stands for "you only live once," and they'll YOLO something around KYC where they just decide not to collect it. And because we're intermediated, we may not know for a few days, right? Or they may come in through the wrong channel. They could come in through that business channel and pretend to be a business, but really they're giving out our products to consumers. So we have to make sure we've got good oversight over both sides of those houses, especially in the banking service place. And then the last thing to touch on is reconciliation. When Marty Gruenberg isn't busy yelling at his staff at the FDIC, I hear he's very focused on reconciliation. And so that's something that we need to make sure that we can do on a daily basis. And if we're not doing it ourselves, if we're pushing it off to the partner, that they can get us the files so we can input it. Same thing too with that KYC data. We want to make sure we're getting that in daily so we can put it into our own AML systems and our tooling, and we can run that and have our staff do oversight over that.
Excellent. Matt W., any feedback as our product guy on everything Matt J just shared?
I think we need to up our estimate for cost a little bit.
I was thinking the same thing. And in fact, a question I had for Matt J, based on what you just shared, is you mentioned tooling. How much of this can I do with technology? How scalable can I be here as I staff up some of these functions, or as I mature some of these functions?
Yeah, I think more and more, if you're willing to spend more for a technology provider, I think you can do more and more with technology. And I think that is a way that partner banks are trying to go right now. And fintechs are also trying to go, right, as they nest with those partner banks on top. So some of the newer providers like an Alloy, or it could be a Hawk AI that's out there. And they have some really interesting tooling and capabilities, which will allow fewer compliance analysts to work queues faster, but get to more efficient results without losing that oversight piece. So I would say if we want to lean into it, we can do it, but it might be a little more pricey up front. At the end of the day, it's cheaper than the cost of a consent order.
Yes. I don't want to be written up in Jason Mikula's newsletter. That's the only thing I'm crystal clear
He's
on.
very tall. He scares me.
He scares me too. Definitely don't want that. I think the other question I had was, as it relates to going out and finding these fintech partners, these fintech programs, should we be working with a middleware platform that can help us find some? Should we be trying to get them directly? Is there a particular size or sophistication that we're looking for? Should we have sort of limits on the size or sort of growth of the ones that we decide to take on? What are the things you're thinking there?
I have views, and I'd love to toss it over to Matt, obviously our business partner here, to share some insights on it. I think either path can work, but if you're going to go direct, right, then we have more insights, more oversights, more control with that partner. And regulators are traditionally more comfortable, right? And we have more visibility on the compliance side, so I'm more comfortable with those types of direct models. That's not to say you can't do an intermediation or a stacking of channel partners, right? Because if you think about it, what a BaaS provider is at the end of the day is they are a channel partner or a platform that you are stacking other digital channel partners on top of that will eventually help the bank reach consumers. But you're going to be going through at least two hops, right? You're going to have the banking as a service platform, and you're going to have the companies built on top. I think one interesting strategy to think about with this is obviously we want to make sure we're working with reputable banking as a service platforms. So there's a few that are out there that are seem to be well staffed. Maybe they have ex-CFPB lawyers working as general counsel or compliance officers or things like that. I think we also want to understand their oversight processes. So someone who's got automated tooling, and you asked again about automated tooling, it's not just on the AML side. You can set things up like, I think it's Change Tower and then Brand 24. And so Change Tower lets you watch websites and you can see anytime the website gets updated. So for example, if somebody says coming soon, here's our sign up list, we can get an automatic ping to all of our email inboxes, or can route through Salesforce to say, hey, they just updated the page to say they're live. And if we haven't signed off on that, we're going to catch that within minutes and we can give them a call. Same thing with, I think it's Brand 24, where what you can do is you can monitor for social activities. You can look across Facebook and Twitter and LinkedIn and other things like that. And you can see what consumers or what other potential customers are saying, both about the banking as a service platform and about the channel partners that are building on top of them. And there is some fine tuning there. So for example, somebody who says, F yeah, I love this company, that's going to show up in Brand 24 as a negative indication. Right. So we want some humans looking at it, because obviously that's not a negative, right? That person seems to really love that channel partner that's built on top of the banking as a service platform that we might work with. But something we can monitor and can give us better eyes and ears, right, over things that are happening. And then ideally, right, because another thing that's going to happen, and I know Matt West knows this well, is if we are not watching, and especially where we are involving cards, Visa and MasterCard will be watching. And there's a chance that they may call us first because they have similar tooling, right, if not using the same vendors. And they have bigger teams. So I think what we really want to head off, obviously, we don't want any issues with regulators, but we don't want any surprises either with the networks because they're going to power both of these services, right? The embedded finance platform for businesses and the banking as a service platform or the direct to startup platform.
Got it. Matt West, anything you want to add in on that?
I think we can work with a middleware provider or technology platform to help drive leads, but we'll want to have contracts directly with all of our partners.
Yes, yes,
That's right. And I would agree with that. I think it's good for the bank to have a direct relationship, especially a contractual relationship with these programs, even if they're onboarded through middleware platforms. David is asking some good questions, so I want to make sure we get to them real quick. And then Brad, think about if you have anything else you want to add, because we're going to swing back to you in a minute. Middleware, absolutely. Synctera, Unit, not Synapse, obviously, given their issues and their current status. But those are the types of folks we're thinking about. There's also some other types of folks that are in there that will do almost a middle ground between maybe an issuer processor and a BaaS platform. So you see Marqeta have a version of this. Galileo has a version of this. Lithic, where I used to work, right, has a version of this as well. So they're not going to offer checking accounts, right, or bill pay. But if you're looking to embed maybe that virtual financing platform, they can be a partner you can bring along, and you can lean on them for some of the compliance tooling. Because one of the reasons I know about things like Change Tower and Brand24 and Hawk AI and those things is because we use the tooling at Lithic, right? And in some cases, we ripped some of that out and we built our own because we found that was better and gave us more control over the platform. So yeah, great question on middleware. And I think there are a lot of good providers out there if folks are looking. Obviously, it helps to call folks like Brad or even call folks like Matt, because there is some informal chatter and feedback you can get about how they're doing and where they are on the reputation pendulum of, are they swinging into danger, or are they, constantly improving their processes, and are they going to be a really good partner for you to work with? And some folks have just had a string of bad luck. So I don't think there's necessarily anything to read into of provider X works here with this bank and bank has a consent order, not necessarily a reflection of that provider, and something you can diligence again by talking to great advisors, whether it's Brad or Matt. And I bet if you called Alex, he's got insights for you, or he can refer you to our favorite.
I'd point you to the two Matts and Brad, but that's a service I can
Yeah.
provide. And then on the question also that David asked about of banks you've worked with, how developed was the risk awareness 18 months ago versus how it is today? I don't know, Matt West, maybe you want to comment on that first, and then Brad, I'd love to get your take on that as well.
Yeah, I describe as the rules haven't changed, but the expectations have changed.
Yeah.
And so that's the regulatory rules and regulatory expectations.
Mm-hmm.
I say all banks are going. Probably the thing that surprised me most as I talked to new banks or CEOs that want to get in is just the level of confidence they have going in before they've even started. Is always surprises me that it's higher. Like there have been a number of times when I've said, "You're way more confident than I am going into this exam," or "You're way more confident getting started." And maybe it's just me. I think I'm pretty optimistic, but not as much as many bank CEOs. So
you're not CEO level optimistic, Matt. That's your problem.
I think so. But I say all banks are working through the same process where you've been in for 18 months or 8 years. I think there's been an adjustment to higher expectations, and the awareness, if it hasn't increased, if the maturity hasn't improved, then that's a predictive indicator of troubles on the way.
Awesome. And Brad, would love your take on that question specifically, and then having ended our current scenario, just feedback for us on other things you would have asked about.
Yeah, so I think the other thing to remember is how much the regulators have increased their sophistication over the last 18 months. I remember I was doing a consent order with an OCC bank a couple of years ago, and everything got referred to DC because they needed specialization and they wanted commentary from DC. Now the field teams have knowledge, they're being trained in this, so your regulatory knowledge base is going up. And with that too, I mean, it's one of those things where I think it's almost impossible. I mean, like I said, we work with dozens of banks in this space, and I'm always surprised at bizarre little tweaks that come up, meaning go back to 6 months ago, 12 months ago, when everybody started panicking over broker deposit rules, right, in the wake of some of the SVB stuff. Not on people's radar. I had two banks that had gotten a question from the FDIC, and it was responded with, two sentence answer in the exam. Now I have multi-day sit downs with regulators over broker deposit issues.
Yeah.
And so, you'll never see all the gotchas in this. And so you just have to understand you have to constantly be evolving here.
Got it. Okay. That is actually a very good segue then to our final role play that we're going to do, where we are going to bring in Brad. What's the name of your fictitious persona?
Yeah, I am Martin Michael Powell.
Michael
You can call me Marty for short.
Well, I was going to anyway, so that is what I should do. All right. Okay, so we are going to bring in Marty, and we'll take the suggestion of having done some thinking on this internally and shaped it into something that we feel pretty good about. And we're approaching Marty before our next exam. So we'll go ahead and do that. All right.
So, I mean,
go ahead.
So those regulators come in. The first thing they're going to want to do is sit down with your head of fintech ops, right? That's usually the first target, if you will, on the list, as opposed to compliance people. And that regulator is going to start asking questions and say things like, Matt, tell me about the infrastructure you have, your staffing, and who in the bank is involved in all of these roles. Meaning, is this a cross-platform, or are you running out of a fintech group in the bank?
Absolutely. So maybe we want to just jump right in there. So I'll be the CEO and be quiet since it's not my role to speak. But Matt West, maybe you want to jump in there with Marty.
Yeah, and apologies, I hid my video for a second and it won't let me add it back. So I'm still here.
You're good.
We're going to have a dedicated fintech team inside of the bank.
And I guess my next question is to regulars. Have you had any past enforcement actions, past concerns? How are you on your kind of long-term compliance across the bank? Any CRA findings, any past consumer compliance findings that you'd like to kind of vent to all of them?
We're all ones. We've been great. Always had a great relationship.
Gotcha. And as you think about life cycling and these things, if we look at kind of that TPRM life cycle, what level of diligence have you guys done on these various partners? Meaning, how many people and how long did you spend diligence?
We set up a new partnership risk management program with the TPRM as the framework, and we meet in person with leadership, and each partner usually takes probably 60 days. They always complain that it takes too long, but in order for us to get through the diligence, review the materials the first time, have some follow-up questions, come back, it's usually 60 to 90 days.
And how well do you document that? Because, obviously in my world, if you don't document it, it never happened. I assume you were lying, cheating, and stealing.
We'll switch instead of giving all the perfect answers. Well, it's probably in my email somewhere.
Okay, so somewhere in the email. All right. In terms of how you're thinking about risks inside of the bank, how do you balance the money that the bank is going to make? What are you going to do with that profitability? And that may be a question for the CEO, because I've had the OCC ask that a lot of times when they're working with banks. Is what are you doing with the profitability of this program? What's the purpose of this money?
Well, from the CEO's perspective, we want to funnel it back into growth. So we want to channel it back in, probably more into our legacy businesses like commercial lending in areas we know really well, but we want to put most of it back into the bank and try to grow.
And how much are you going to spend on building the infrastructure? Meaning, how many employees, full-time employees, are you thinking about tagging on to augment this program? Your $500 million deposit gathering fintech partnerships.
I think the compliance officer needs to answer that one.
Or yeah, go ahead.
They're always the ones spending the money.
Matt Janiga.
Yeah, so just thinking about it, I think Matt, I'm going to veer into your lane slightly, right? I think we want some relationship managers on the business side, right? Folks that can liaise with the business and product and entrepreneurial folks at the customers that are building on top of us, the banking as a service, or the other channel partners that are building on top of them, the other fintechs. From my end, I think we want to make sure we've got someone who can manage consumer compliance, right? Because today that's stretched across someone who's busy with our core retail bank. So really want a new hire for that. And then I think our AML, our BSA AML lead can handle the management of this piece, right? And can work with me on the policies and other things. But we're going to need at least 2 more analysts in that space. And I think we intend to use those folks, because obviously we're not going to explosively scale overnight, right? None of these programs go from 0 to 60 immediately. Unless you're taking an established business like a Cash App, and they're coming to you and they're adding a new product with their 40 million customer base already. So we expect to work with smaller startups, and so I think we'll start with 2 for now, and then we'll work with the partnership manager to make sure that we're gathering the diligence. So we're going to do monthly oversight and monitoring, right? We're going to do sampling of all the files, both on the KYC side, the sanction side, collateral, terms, and make sure that they're getting and keeping all the records we need, and we have access to them as the bank.
And are you offering past due FDIC insurance to any of these consumers, or is these going to be uninsured deposits or payments?
I think we had not planned on doing that, but one of the things the Alex and Matt and I may want to take back is we're going to put these consumers into pure demand deposit accounts. We're opening and holding deposit accounts for them at the bank, or are we going to do an FBO account where they'll be sub-accounted either by us or by the middleware layer, right? The banking as a service provider out there. So I think we want to hold the reconciliation. So I don't think we'll work with a middleware provider that is going to do that on their own, as we've seen some bad issues with that with Synapse and elsewhere. But I think we're open to being flexible, and I think especially on that business side, right? It's probably more typical to do an FBO account as opposed to pure accounts, because we're going to be offering one-time virtual cards that can be pre-funded and then used for business purposes.
And a couple final questions, just kind of get a feel for your knowledge on this is, have you thought about the liquidity concerns? Meaning, are you building living wills for these fintechs? And, candidly, is your board prepared to exit this relationship and has come up with timelines for it if this doesn't go well?
So Matt told me we're only going to work with fintechs that have 24 months of runway and funding. So we've got a good head start there. And then one of the things we're going to do as part of our regular oversight is we're going to get quarterly financials from them. Company prepared, but we do expect audited in the annual basis. So we'll pull that up and see how they're doing. And I think if there's any concern either on the compliance side or on that financial side, right, Matt's committed. He's going to help flag up to us that Alex needs to take a look, and maybe our CFO needs to take a look at do we still want to continue that relationship? And then Alex is committed to me that as long as we go to a couple of Celtics games together, I can kill any fintech program I want as the compliance officer. So I feel very empowered by that.
And I guess then the question is, if you do kill those all, how does that impact liquidity at the bank? Because that's obviously my biggest concern now as a regulator is when you start killing these people off, what does that do? I don't want to be in headlines. I don't want to have after action reports written about my team looking at my bank failures. I just want you to keep me out of the headlines. How do you think about liquidity?
Yeah, so I think first I would start with thinking about that consumer impact. So first, let's think about the types of products that are coming on board. And when you're working with fintechs in this space, obviously everybody dreams of maybe working with like a Raisin, right, where they're doing broker deposits to just swoop them over to you, and you have big balances coming in or sizable balances coming in, especially in aggregate. In actuality, if you're going to do banking as a service, you're probably going to get consumers who don't put a lot of money into their accounts. So if you get 1 million consumers, right, and they all hold an average of maybe, let's say, $100, you can get a nice boost in your balance sheet. But as a whole, you're not going to have too much money sitting there for too long, because a lot of these consumers, the reason they're coming to us or they're coming to our channel partners is because they don't want to pay a $12 fee from Chase, right, on a monthly basis. And so they're coming here because we're a lower cost alternative, or we're providing them access to things they can't get because maybe they have a negative history, EWS or something else like that. The effect of that is that those consumers can run off pretty quickly. So if you're thinking about what we're doing, right, obviously we want to make sure that those deposits and then the lending activities we're doing against them, that we have enough liquid cash on hand where if we did need to wind down those partners, right, we could run that off pretty quickly. Let's say I think 30 to 60 days would be an ideal scenario. But if you really had to exit somebody quickly, you could probably stop new onboarding immediately and then tell them to send notice to all their customers they've got 2 weeks to pull their money out, right? And then otherwise, you can push out ACH credits or paper checks, right, to some other source as needed things, or maybe even migrate them to one of the other customers that's on your BaaS platform. So there's a couple different things, that are available to us there. And I think, from a concentration perspective, my understanding is, right, we don't want to go above probably 8 or 10%, right, for any one program of the balance sheet.
I'd get
But
nervous as your regulator if you went much above
yeah,
it. And I guess
Bre-
last one, Matt, a couple of weeks ago, you and I were talking. You talked about how you're going to ramp up this program like a crawl, walk, run model. I see headlines. All the guys at the water cooler here around DC are talking about having to deal with these crazy fintechs that lie, cheat, and steal. How are you guys going to make sure they're actually not lie, cheating, and stealing? Because, I don't want to be in headlines.
well, gosh, everything starts with our great business team. So Matt West and his relationship managers obviously are going to hold a high bar, right, about who comes onto the bank, and we're going to impose high standards on that banking as a service platform. And I think that's a key thing, right, for folks who are thinking about this. You don't want to just open the floodgates for your banking as a service partner. You want to set some parameters and restrictions with them about who can come on board and who can they onboard. And I think again, in startup land, you want to think about runway. So how much money do these folks have, or are they bootstrapping? Is there a person there who might be independently wealthy and maybe you want some type of personal guarantee or want to inch towards something like that, right? If you run into issues around that. I think from a crawl, walk, run, obviously we would love to work with an established middleware partner who's proven themselves to be a good partner at other banks, and then maybe take one of their better programs as a first partner over here. So either splitting volume, and a good example of that, they didn't come through middleware, but Chime's a good example, right? They started on Bankwart. They learned how to be a good fintech thanks to Bankwart. And then not to
we are
Hufflepuff.
actually close to wrapping up, so we'll end the scenario there. That was awesome. Brad, can I turn a question back to you to kind of wrap up?
Sure.
So you were giving the scenario from this is how you would be interacting with the bank when you're talking to them as a regulator. This is the questions you'd be asking. What would you be saying to your peers after you left about our answers and about how that conversation went?
Yeah, I think my biggest concern if I'm inside the bank is I think we need to have a very detailed roadmap to scale. And what I mean by that is I treat every new fintech bank as part of a corrective action plan and a look back. Meaning when I'm doing my first, because remember, the regulator is going to nail you on ECOA if you're lending and BSA AML back if you're payments.
Mm-hmm.
Make sure those are strong and make sure you're verifying the partners. Meaning the thing that just kills me is when I have bankers go in and say, well, we had a reputable partner, we trusted them. That doesn't fly anymore with regulators, and you better have the documentation to independently, if you are delegating any regulated activity out of your bank, you better have conducted due diligence, have controls around it, and have a testing and monitoring program. Because if you look at all of these consent orders and formal agreements, what's the first thing the regulators make you do? They want the bank and its consultants to do a look back and verify the fintech partner's activity. You just do it out the gate. And then once they show it for 6 months, crawl phase, give them some runway, let them run for a year, run a little bit of parallel. After 2 years, yeah, maybe you outsource those key roles to them. But I will tell you, the hardest thing with a small bank is you got a sophisticated payments company with rock and roll BSA AML controls, great tech, great software, AI, whatever, millions of dollars in infrastructure. And you're going to have to feed it into a 1980s core banking system and try to have an AML software, integrate that data, run it at a sub-ledger level, and then give you testable results. And 100% of the time that didn't suck. So, just be ready. You need a good chief technology officer who knows about doing integrations with your bank.
Yeah, absolutely. Matt West, any additional comments from you on that last interaction on the regulatory side?
Yeah, I was going to add on in the earlier conversation with this one, I think every bank that's looking to get into this, one of your investments will be in a supplemental transaction monitoring system. Your traditional core won't, the one you're using with your traditional core won't work. So that's one investment that everyone has to make. Then on the hiring side, there's questions and back and forth on hiring. Just to add the three roles I mentioned earlier, what relationship being one of them, plus the risk compliance and then the operations/technology person. There's probably this middle layer of AML leadership that after 2 or 3 programs, that middle layer of manager. So it can't all be on one AML officer, but a governance leader within AML, a compliance and testing leader, someone handling the model risk specifically to that. So that middle layer, and then the variable cost tends to be just AML analysts based on number of transactions. And then you could say similarly, consumer compliance, somewhat related based on the number of customers. But from a overhead, those are the ones that I see most often.
And I'll quickly quote an FDIC director I presented with one time, which is you wouldn't open a branch of the bank without every vertical in the bank signing off on the program. Why the hell would you do it in fintech? Like the kiss of death here is a fintech group that's isolated and siloed. Yeah, I joke with my banks. It's like, you know, the Apollo 13 movie where we got 50 people in a room and every guy and gal has to say go for launch. I'm going to make everybody in each vertical of the bank put their name on the dotted line and say go for launch. And I hereby say I looked at it, I'm comfortable with it. I'm ready to put the bank's name on it. And you want to freak some like legacy community bankers out, make them sign a document that says they've done that review and they are approving the launch of the fintech partnership. That I mean, they're vomiting all over the walls and stuff like this. But make that level of integration into your bank. Have every risk vertical in the bank involved in this. Don't wall it and isolate it.
Yeah, I think that's good advice. If anyone has any questions they'd like to submit as we're wrapping up, feel free to drop those into the chat. And while you do that, I'm hesitant to say this, but Matt Janiga, any final words from you?
No, I think I've done enough.
No, that makes perfect sense. Well, all right. I don't see any additional questions come in. There was an early
I
one
did see
about
David's question. Is regulatory scrutiny increasing? Yes, it
Oh,
is. More people are getting sophisticated at the regulators. They're going to keep increasing and becoming more sophisticated. And you got to be monitoring each of these consent orders and guidance docs because we're getting new questions the day those drop. The next cycle, I'm getting questions from my banks.
That's a good answer. Yeah, I mean the consent orders are a good way to see the sort of evolving education of regulators, I think, on this stuff in a lot of ways, because it is kind of the public documentation of like, oh, we saw this, we'd never seen this before, but now we're concerned about X. So I think keeping up with that is really, really good advice. There was an earlier question from Eric around, does Celtic Bank have the capacity to reconcile all new activity and account for it properly? Post Synapse, we certainly do. So we will be investing in the appropriate reconciliation capabilities. All right. Well, with that, David and Nick, I will turn it back to you. That is the webinar. Appreciate it, everyone.
Well, thank you guys. I think I'm off mute now for attending. This has been a fantastic discussion. First, on behalf of NIPAY, I want to apologize for the unexpected intrusions. This is kind of like fraud management in the payments business. You're always playing catch up, so we're playing a little bit of catch up. So very sorry for the surprise that has occurred during this event. That has not detracted from the quality of the discussion.
No,
So-
thanks to all the participants and thanks for soldiering through.